So let's do the 2017-2018 multiple choice questions. All right, let's just let this load up. Okay, so question 1. What is the main activity in the primary market of the stock exchange? So you've got primary and secondary markets. The primary market is when shares are first issued, so it's the initial offering. The secondary market is when, general, and the primary markets are generally for much bigger institutional investors or much bigger, wealthier individuals and high net worth individuals that have got lots of cash, basically. It then comes through to the secondary market. The secondary market is what you and I would generally purchase from. That's where we would usually purchase from, because they're just where you go to your broker and you buy and sell existing shares that have already been offered to the public. So they've already gone through the primary stage. So the primary market, the main activity in the primary market, the answer to that is D. Yeah, because brokers sell shares for investors. They would do that in the primary market, but it's not the main activity. Investors raise funds from firms. That's not the case. And investors buy and sell shares between each other. That's the secondary market. So it's D. The capital asset pricing model. Well, it doesn't calculate systematic risk, because systematic risk is calculated by beta. Yeah, so beta calculates the systematic risk of a share. The capital asset pricing model uses beta to calculate an expected return. B relates the expected return on a security to its systematic risk. Well, the answer is B, because it uses beta to figure out what the systematic risk of an entity is. It assumes that the systematic risk of the market is 1. And so if something's got a beta of 1.1, it's a little bit more risky than the market. Okay, so that's what the capital asset pricing model's done. It doesn't measure the expected return on the market, because it uses that to work out what the return on the security is. And it doesn't calculate the equity risk premium, because the equity risk premium is the difference between the risk-free rate and the expected return on the market. So the answer is 2B. So now question 3 is a weighted average cost of capital question. So it says, if a company is financed 3 million by debt and 12 million by equity, the after-tax cost of debt is 2% and its cost of equity is 10%. What you do is this. So you want your total cost of capital. So cost of debt is 2%, cost of equity is 10%. Total of that 2% is made up of 3 million by debt, 12 million by equity, and this is the total, yeah? So then you divide that by that, yeah? So 80% debt, and you got 80% equity, 20% debt. And you times that 2% by 20%, then you times that 10 by 8, by the 0.8 you get 8, and then the answer should be 8.4. Okay, yeah. So you take the 2%, 3%, and then you weight them. You weight the 2% by how much of the 2% is made up of the total debt and total equity, yeah, which is only 8.4. So the answer is D. An investment will cost 2.8 million. It will yield 800,000 for the next 5 years. What is the payback period? So 1, 2, 3, 4, 5. If we put, it's going to yield 2. It's cost, how much does it cost again? 2.8 million, yeah. So you got 800,000 per year for 5 years, yeah. So then what we're going to do is we're going to do this. I'm going to put that there. That. that actually, because that won't do anything for me. I'm going to do that. I'm going to do that. I'm going to do that. So as you can see, we're getting closer and closer. So we are at the point now where it's 3 years. We've got 3 years. We still need to pay back 400,000. Yeah. Well, 3 years, and then 400,000 divided by what? By that is 0.5. So it's 3.5 years. Yeah, you see. So 200,000. We pay 800,000. 2 million. We've got 2.8 million. We got to pay in year 0. Yeah. We get 800,000 in year 1. That's paid back 800,000, leaving 2 million. In year 2, we get another 800,000. That leaves 1.2 million to pay back. Year 3, we need another 800,000. That leaves 400,000 to pay back. Then we get another 800,000 in year 4, but we only needed to pay back 400,000. Therefore, we pay it back within half the year. Yeah. So we pay that half the year, so it should be 3.5 years. There you go, 3.5 years. A. So the following internal rates of return are calculated for 2 investment projects. IRR is 8% for project A and 10% for project B. What investment decision should be taken if the cost of capital is 12%? Well, with the IRR, if generally the NPV is the main decision making in the decision deciding factor in the in project appraisal. So NPV is the main one. IRR you can use, but NPV is the main one. So as you don't have that here, your IRR, so basically what the IRR says is your IRR should be equal to or greater than your cost of capital if you are to accept the project. As the IRR for both projects is less than your cost of capital, there's no point, because your cost of capital, there's no point in you investing funds into this, because you're not going to pay your cost of capital back, because your IRR is 8% and 10% for project B, so you would reject both projects. It's better for you just to return the money to whoever you're borrowing it from, because you're not going to get a positive return on it, so it's pointless. Using a 8% discount rate, the present value of 400,000 received in 5 years from now is, so, and it says using the discount factors provided at the end of this page, at the end of this paper. So what you would do is you would take 400,000 here, go all the way down to the end of your paper. Yeah, and it's 8% discount rate, right? 5 years, so it's 0.681. So you would just take 400,000 equals 400,000 times 0.681. 272,400. So A, the answer is A. Okay, which of the following most accurately describes risk? So the possibility that actual return may be less than the expected return, the possibility that the actual return may differ from the expected return, the fact that the real value of cash varies over time, the possibility that the investment may be worth less in the future. So I believe, from my studies and what I understand, this is one of those questions that is not always clear. But I think that the answer here is the possibility that actual return may differ from the expected return, because the risk, the point is, obviously gaining extra higher than your expected return is a good thing, but it's a risk that it can happen. So it's not that it might just be less than the expected return. The possibility the actual return may differ from the expected return is the most accurate description of risk. It might not necessarily that it'd be less. A horizontal takeover. So this is simply that. So B is a vertical because it's at different stages of products and different industries. Or it's a conglomerate takeover, B. So a combination. A horizontal takeover is B. Is C. The combination of two companies operating at the same stage of production within the same sector of the economy. It's a horizontal. It's linear. Like it goes. It's a horizontal line. Think of it like that. You know, you're just staying on the straight line, going across. All right. What is the discount rate used when calculating net present value? So the discount rate that you use is your opportunity cost of capital. Yeah, it's always the opportunity cost of capital. There's no point using the bank rate because that's just your debt. The internal rate of return, no, because that's your internal rate of return is based on the project cash flows and what it would take to make them zero, the NPV zero, so that's not the correct usage. And the interest rate is also not the correct usage. So because the opportunity cost of capital is what you are foregoing as a result of investing in this project. So it's the returns, it's the opportunity cost, it's the next best alternative that you are missing out on as a result of investing in this project. Okay, so it's the opportunity cost of capital. Which of the following parties, according to academic research, is the least likely to benefit from takeover activity? Well, that's usually the acquiring company shareholders get the worst deal. And that's for a range of reasons. Usually because either management may not be acting in their best interests, or management are going to end up paying a much higher price, because obviously companies that are being purchased don't always want to be purchased, especially not management of the company, of the target company, don't want to be purchased. So usually people have to pay a premium for it. That premium usually wipes out quite a lot of the synergies gained from joining the two companies together. So generally then the target company shareholders generally do quite well out of it because they get paid the premium on the shares, whereas the acquiring company shareholders are the ones essentially paying that price. So they are paying a lot of money for something. So with respect to the issue of ordinary shares, which of the following best describes a placing? So a placing is best described by shares offered to institutional investors at a fixed price. You place them with private investors, basically. That's why it's termed place. You know, it's not creating a market for it or anything like that. You just agree a fixed price with institutional investors. It's cheap. You won't get as good price if you went as an IPO, but you reduce the admin fees and everything like that, and it's a bit easier. It's a lot less burdensome to do. So number 12, Tring PLC has 7.5 million ordinary shares outstanding. It wishes to issue 2.5 million shares. Which of the following best describes a necessary offering? So you just take 7.5 million and I'm just going to put 7.5. You just do 7.5 divided by 2.5 and you get 3 for 1. It will be a 1 for 3, yeah? So it'll be 1 share for every 3 that you own. Okay? The reason why it's 1 for 3 is because if it was more, if you were issuing more shares, you would do it the other way around. So if you were offering like 22.5 million, you would do a 3 for 1, because then you would do this. You would do equals 22.5 divided by 7.5, and that would give you the 3 for 1. But it would be the other way because you're offering more shares than the people have. So you would be giving them additional shares, whereas you're giving 2.5 million away. So that's why you're not. And if you were offering 7.5 million for 7.5 million, you'd be doing a 1 for 1. So when you're offering it, you just take the amount that you have. 2.5 divided by 7.5 divided by 2.5. Okay. Which of the following statements is consistent with Modigliani and Miller's dividend irrelevance theory? So dividend irrelevance theory is just generally the theory around that investors don't care how they get their money, whether it's in the form of dividends or price growth. Because in forms of capital growth, that is, to Modigliani and Miller, a form of dividend because they can just sell the additional shares if they want to get a dividend through price growth. So it doesn't really matter. What really matters is investment decisions, to Modigliani and Miller. So, generally the dividends irrelevancy theory says that your dividend policy shouldn't affect your share price because it doesn't really matter, because you should just be able to sell your shares if they're growing well. What really matters is the investment policy of the business. However, that's not really the case for a number of reasons, but we won't go into that now. So, what is this? So C. Investment decisions are the sole determinant. Based on what I said to you, investment decisions are the sole determinant of company value. So it's C. Weak form market efficiency. So you've got weak form, semi-strong, and efficient and strong. So what weak form efficiency says is basically that it says that A. So A is weak form efficiency. B is semi-strong efficiency, and C is also semi-strong efficiency, and D is strong form efficiency. Okay, so A is the answer. So it's only past historical data that is reflected in the share price. Okay, a security with a value of beta equal to 1. Beta equal to 1 means it's equally as risky as the market, as systematic risk, because beta of 1 means your stock prices move with the market exactly, so it has an equal risk to the market if you've got a beta of 1. At higher levels of gearing, the WACC curve steepens to reflect which risk? It's bankruptcy risk, because that's obviously you're increasing your gearing. So at that point, at a really high gearing level, you see an inflection in the curve, a really steep change in the curve, and that's when investors start getting worried about bankruptcy risk. Okay. According to the clientele effect, dividends carry information to the market. The level of dividend payments is a function of investment opportunities. Dividends are worth more. So the clientele effect is answered by D, because it's what the clientele effect. The definition is simply that different investors have different desires. Some from dividends, so some want consistent dividends. Some don't really care. So depending on their preferences, they will buy certain companies. So those investors that want high dividends, they might be some people who are, who don't have a high income. So they might be, they might not care because their tax will not be affected by dividends. Whereas those people that have high incomes might not want dividend shares because they have to pay tax on them. And there's a different type of tax because dividend shares will be taxed at a higher rate than, say, capital gains. And capital gains tax is something that you would only get charged if you sell the share. So, so that's what the clientele effect tries to get to, the different desires of different investors. And the clientele effect is answered by D. The traditional theory of capital structure proposes that a company's value, the traditional theory of capital structure proposes that D, a company's value, is affected by its capital structure, and that's due to the tax shield. So as we discussed, I think probably in a previous video, that if you increase tax in your company, you can essentially reduce your it's tax deductible basically. So if you increase debt, it reduces your tax, but essentially it's a cheaper way of raising finance because it's tax deductible. So, there is an argument to be made that, that tax shield that you get is essentially you're getting a bit of money for free, basically. And you're actually not borrowing as much because of the tax shield. Okay. So a company's earnings for 2017 are 23 million. They have 27 million shares in issue. What are their earnings per share? You just take, so your earnings per share are literally what was your earnings, by how many shares you have. So you just take, as it's 23 million, 27 million, they're both the same unit. You can just do 23 divided by 27. Yeah, and it's 0.85. So C is the answer. Agency problems between shareholders and managers can be tackled by awarding share options to managers. So that is all the above. So all of them, agency problems can be tackled by all the above. Electing an independent auditor keeps a check on management's behavior. Awarding them performance-related pay, if it's done properly, you can get them to act in the interest of shareholders. And awarding share options is the same. It's a form of performance-related pay. So all of the above is the answer. And usually when you've got all the above, if two of them are right and you're not sure about the other one, you can pretty much guarantee that the other one's correct. So, because obviously you would want to choose both, but you can't, so you would have to assume that the other one's right. Okay.